Hello, everyone. Today on the final bar, we're going to approach the market from three directions as we do every Monday. Top-down macro sector rotation, bottom-up stock picking. So much I feel like has happened since Friday's close and Monday's close, including a market gapping significantly higher with things like energy up double digits, but distributing a good amount of that right into the close. We're prepping for the show. I'm watching things accelerate to the downside. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we try to make sense of these markets together using the charts, using the power of StockCharts.com, technical analysis, behavioral finance, investor psychology, sentiment, decision-making, whatever we can to make sense of things. But it's almost nonsensical. I'm giggling a little bit as we begin the show because I'm seeing just in the last 8 hours or so during the trading day what a series of emotional movements the market has been in. If you question at all whether the market is driven by emotion, I challenge you to look at the last 48 hour last 2 trading days and try to think anything different, or even just the last week. Today, thinking overnight, really when the futures opened yesterday, you saw the movement, the news from Pfizer really, creating a gap higher today. But most of this day was spent in a pattern of distribution. I haven't been able to process all the closing data here. Usually I have a good sense of what things are going to look like. Today we're going to be a little bit cold and just see chart by chart how things ended up, because I'm seeing some of the key sectors like tech and communication services down pretty good today after they were finishing more positive not too long ago. We've got some great guests this week helping us out to make sense of things. Last week, I was so excited with some of the conversations. We had some really thoughtful long-term perspectives on breadth and trend. This week is going to be more of the same, I think, in terms of quality of guest perspectives. Tuesday on the 10th, we have Brian Shannon from Alpha Trends joining us, talking about Anchored VWAP, which is a technique he created, which we now have on ACP. Little preview of a special event he'll be doing very soon on StockCharts TV. On Thursday of this week, we have Craig Johnson from Piper Sandler joining us from Minneapolis to share his take on things. When I remember talking with Craig when the market was, well below 3,000. This is during the March low period and soon afterwards. And he was telling me, I remember him saying S&P 3,600, and I thought he was absolutely nuts. He has certainly been validated by now, and I'm very interested to hear his take now. Coming up next week on the 17th, we have Jesse Felder coming back on the show. So in terms of a market recap, again, I had really grand plans to talk about the market blowing to new highs, how 3,600 was in the rearview mirror, and what this means for the long-term trend. What's interesting, though, is from the open to now, that picture has certainly gotten less rosy. Now, having said that, the S&P finishing around 3,550 and still finishing over 1% higher than where it closed on Friday. But some key stories here, and there are a lot of different themes we're going to touch on as much as we can. Theme number one, the emergence of small caps. Look at small caps; they're up 4.8%. If you look at small cap value, which is IJS, it's up 6.5%, breaking out of an established base for the last 6 months. So while the S&P finished in the positive, small cap value, just as one particular, was up as much as 8%, I think, earlier in the day, and settled down a little bit, but still, leading the market higher out of the 9 style boxes. So the small cap index up almost 5% in the form of the S&P 600. Theme number two, technology down, and sort of the FANG trade, the NASDAQ 100 down over 2%, and again opened the day sort of in the positive as with everything else, but finished well down below the open and really made a new swing low here for the last couple of days. So this is on a day when energy is up 14%. The NASDAQ 100 is down 2%. So I ask you to make logical sense of that one. Let's continue on with more themes. Bonds weaker, and they ran a little bit into the close, but really it was a gap lower in bonds in the form of the TLT, a gap higher in stocks. The dollar, which we've been talking about, a weaker dollar thesis and what that might mean, dollar actually rebounded today and accelerated pretty good out of the open with the UUP up 0.6%. 10-year yields up today, obviously on lower prices. In terms of commodities, one of the things that got hurt the most, gold and silver, so precious metals down significantly, but oil down. Oil up in a very big way at the same time. And cryptocurrencies essentially flat to down. It was a mixed bag of sorts, but Bitcoin, the most widely followed, almost finished back in the green, but essentially flat after a fairly volatile session. I mean, just look at the sector returns today, and we've talked about energy, we've talked about financials. These have been the have-nots compared to the haves, which are pretty much everything else. Everything else has had its moment where they've emerged, and energy certainly has not. And financials, little glimmers, but not really pushing higher. Today you had lower prices, higher yields, and financials really going higher with the XLF up 8%. So again, that's another theme. The strength in energy is pretty impressive. Now this is coming off of a fairly beaten down level. So overall, I still, it's tough to question something as it's gapping higher 14%, but certainly in terms of the long-term trend, not nearly as impressive as any of the other, most of the other sectors, I would say. Overall, let's look at a chart of the SP. We're going to try to tease off as many of these as we can. And sorry, I'm a little scattered as I'm looking through. As I was looking earlier in the day, you had the gap out of from Friday's close to today's open. Totally fair. We accelerated to the upside and pushed above 3,600. And I've been telling all of us on this show for a while now, 3,200 to 3,600. That's the range. Until that range is broken, it's essentially telling you it's range bound. And earlier in the day, it looked like that was the all clear signal. That is, victory. We have eclipsed 3,600. We're going to 4,000, if not higher. This is everything fine. By the close, though, if you look at what's happened, this feels much less like a dramatic breakout to the upside and much more like, even though it was a 52-week high today, and it feels much more like a further establishment of the importance of 3,600 as resistance. Now, that level is clearly going to be important. This is the level we peaked out in early September. We got near to that, and that's why I sort of set this range 3,550 to 3,600, because that's where we, approached those levels. We got into the range of the high day, but then turned lower. And then now we've had a third attempt to break above 3,600, and it's been stopped at this point. So we still now have not closed above 3,600. That is the line in the sand. That's the resistance. And until that's eclipsed, I still think that's a ceiling in the market. And today, instead of validating a breakout to the upside, I think more validates the importance of that as a resistance level. So until we break above 3,600, I still think you're tapping the brakes mentally with that. In terms of accumulation, or in terms of the advancers and decliners, at one point, this is almost a 90% update that came back down. It's still 76%. So we've had 3 days in the last week or two where you've had almost 80% of stocks closing higher than yesterday. But again, not a 90% update, not a full-on everything's all clear sort of, broad, wide accumulation. Certainly more accumulation than distribution if you look at some of the individual days over the last week and a half. That's right, because the market's gone higher, but it's not the severe follow through I think I certainly may have been expecting today. This one is not updated yet, but I'll be very keen to see how this plays out. These are cumulative advanced decline lines here to wrap up the market recap. When we've looked at this, we've talked about the breakout in stock prices, but the confirmation or lack of confirmation that comes from the cumulative advanced decline lines. The key one we've been looking at is this one, the large cap advanced decline line, which is in green. And so that broke above the peak from August, has now retested that in late October, and now back near the all-time highs. I was expecting this to break to the upside. We're going to see how this plays out in the next hour or two, but that's certainly something to watch to see if we can continue to push to new highs. Now, the real question is whether small cap advancers decliners will confirm what we've seen elsewhere. Based on what happened with the small cap index, I think we're actually going to get that. So I think we may get a full upside confirmation on today, but we'll have to see. And this is the NYSE advanced decline lines at the top. So just because small caps were up so big as a broad group of stocks makes me think that we might get the upside confirmation, but I think we'll have to wait and see. At this point, it's still some positive, which are the large cap and mid cap, and then some neutral still, which is the common stocks on the New York Stock Exchange, and then the small cap breadth index. So we have a lot of other things to talk about. If you remember, on Monday we talk about the broad market, we talk about sectors, we talk about stocks. So there's a lot of stocks that sort of gapped up huge or gapped down huge. We're going to try to test or just touch on as many of those as we can. But our next segment right now is getting into sectors. So we talked about the big picture, and certainly it's weaker metals in terms of gold and silver. It's stronger stocks, but with a lot of distribution during the trading day. And really, this was the emergence of financials, energy, small caps in a way that we've not seen in quite a while. And maybe that is the most important theme that we see today, not the S&P breaking up, but some of these other sort of unloved parts of the market sort of emerging and taking some space from large cap growth and large cap tech and consumer. Let's get to our look at sectors. The way we usually focus on this is using the RRG, the relative rotation graph. And as always, if you're not familiar with this, Julius DeKempener, he was on the show last week or the week before, I forget which one, I think it was last week. But his show, Sector Spotlight, is a fantastic summary of how to think about this visualization. But we're looking at how the 11 S&P sectors are rotating around the S&P 500. They're in the middle, and the theme that has been emerging over the last 5 to 6 weeks has been, again, further to the right is stronger on a relative basis. So you can see that consumer discretionary and technology, while they still are, in the upper half of sectors, they're rotating southwest, sort of rotating away from this position of strength. And a day like today is certainly going to continue that evolution that we've seen. We also have seen the rotation to a more positive light of materials and industrials, which are the two, looks like at this point, the two strongest sectors, the only two remaining in the leading quadrant at this point. But then you have these other ones that are sort of merging. Utilities has been one of the most important ones. Healthcare as well, and obviously you've had Pfizer and others with a lot of movement given what's happened. But overall, you've seen them sort of rotating higher. Here's financials, which have sort of been in no man's land, but now starting to improve. And again, I think today you're going to see, the relative strength on a lot of the banks start to improve dramatically, just based on the move higher that you had. Energy again is still further down and to the left than anything. It's rotated a little bit more positive for sure, given the move that you had today, but not quite enough to be impressed yet. Now let's look at the daily view, and now we can see some of these short-term themes and how they've evolved. Here we can see utilities, which again is still the strongest by the fact that it's the furthest to the right, but you can see on a short-term basis, it's given up some of the relative gains. So even though it's still outperforming, the momentum's coming off there a little bit. One of the most ideal patterns I think you can see on the RRG is something that goes into the weakening quadrant, rotates back to the northeast direction, and gets back into the leading quadrant. That's something we saw with technology and with consumer discretionary for a while. That's just rotating around this, doing a loop over here on the right side, which means overall it's still outperforming. It's just fits and starts. It's, aggressive outperformance and then a little bit of tapping the brakes and continuing. So that's what I would be looking for with utilities, to see if it's able to reemerge and go up here. But you can see a lot of sudden movements on the daily RRG, with industrials rotating back northeast, financials northeast, materials northeast. You can see consumer discretionary and staples kind of heading southwest now, and energy, which had been looping down in that negative direction, is very quickly turned in the more positive. So again, one day, it's hard to draw a trend from one day, but that's certainly a theme to be looking at, especially for so many that have not been in energy for the longest time, because there's just been no great relative reason to do so. So looking at the sector charts here, the 11 S&P charts, we can see overall, many of them above their 50-day moving average. I'm only counting one. I was going to say financials, but not with the gap higher today. So you only have one out of the 11, still below their 200-day, as I'm glancing very quickly, which is pretty impressive. I'm actually not seeing any of them below their 50-day, given the movement that you've had now to the upside. So overall, they're all above their 50-day. Most of them above their 200-day, except for energy, which is the only one that remains below it. So, so a couple big takeaways. Something like consumer discretionary, this is, what is maybe further validating this resistance that we've seen. If you look at the evolution of the XLY from the March low, it actually bottomed out a little earlier than the overall market, which bottomed out in March 23rd. This is sort of mid-March. but accelerated to the upside. And you can see the relative performance since late March has been exemplary. It's been one of the strongest sectors by far. But now we see on the XLY, it's around 154 or so, which is resistance there in early September. We retested that, made a bit of a higher high in October, pulled back a little bit. And then today, again, earlier in the day, looked like this beautiful follow through move to the upside. But if you look at the direction of the day and what actually happened, after we gapped up at the open, all other data we got from the XLY price behavior was more negative. This is showing you distribution. This is showing you people taking profits as the market gapped higher. That is not, you want things to be pushing higher and accelerating to the upside, like you saw with some individual stocks, which we'll get to a little bit later in the show. But broadly on the XLY, and again, this is geared more toward the broad, and this is going to be Amazon and others that are going to be a pretty big weighting. Amazon's down 5%, so the XLY is certainly not going to impress to the upside when such a big name is struggling. But you can see that it's gapped higher, but then closing lower, even closing below yesterday's or Friday's close. So overall, what that's doing for me from a technical perspective is it's less indicating a breakout, even though yes, it was a new 52-week intraday high. On a closing basis, it's still demonstrating its inability to break to new price highs and to follow through there. So that concerns me on the chart of the XLY. That concerns me on the chart of the XOP, which is further giving a bit of a triple top appearance to what we saw there. Communication services, which is a bit of a bearish engulfing pattern now, given the distribution that you saw during the day. So, some of these leading sectors, this is technology, the last one we'll look at. Again, it's sort of, instead of breaking out of this pattern to the upside, it's actually closing back within this consolidation pattern that we've been seeing. So the day evolved from being an impressive breakout to less of an impressive breakout. Now let's look where the upside has actually either held in or been a bit of a follow through. Financials, number one, you can see the gap higher to 27. We're now above this June high, and the question now is, do we hold that? So on any chart that I'm looking at like this, I'm always looking to the left. I'm seeing where we are at relative to where we've been. I would argue 2650 becomes a huge level of support going through the remainder of the week. Is it able to hold those June highs, or does it finish back below there? And I think that'll tell you a little bit about the potential of something like the XLF to go higher. With energy, again, it's impressive that we've now broken into new swing highs. In the short term, I think you look on any pullback, assuming we can establish a higher low, and that would be the beginning of a reversal to the upside. It's hard for me to think that this is, that we go straight up from here. This is more of an impressive breakout that I think now needs to be validated, needs to be confirmed with some sort of follow through. So wow. It's a blur looking at these charts and how quickly they evolve through the course of the day and really accelerating into the close. But with most of these, I'm seeing intraday highs. I'm seeing closes that are back below Friday's range or back there. So any sort of assumption you had about an upside breakout is not there. What this does tell you is certainly about a potential change of character, and things like financials, energy, industrials, gapping up and at least holding some of those previous levels, materials as well. It could just be, more of a transition. Maybe this is a continuation of that transition away from mega cap tech, communication services, the FANG trade that seemed to sort of be lightening up last week. Maybe this is a resumption of that move. We're going to try to dig into this and much more as we come back from our break, and we'll talk about shifting stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. Appreciate you joining us every weekday after the close as we look at these charts together and reflect on what is evolving real time in the markets. As a reminder, the best part of the show, I think, hopefully, is the fact that it's interactive. You can get questions to us. We'll review some of them together on the air and address what's coming up in your natural process of analyzing the markets. 3 ways to get your questions our way. Number 1, via email, thefinalbar@stockcharts.com. Number 2, on Twitter @FinalBarSCTV, or on our YouTube channel. Number 3, just put a comment below the video that you're watching. We're going to capture all of those We'll address as much as we can in the coming days. We'll do another mailbag segment Tuesday of this week, and again at the end of the week. So get your questions in. We'd love to hear from you. Our next segment is called Shifting Stocks, and during the break, my producer Gretchen is mentioning that I'm a little heavy on time, which is true because and again, the market evolved so quickly today. And I was talking with my wife actually over lunch before, because we're recording this in the Seattle area, so it's just after 1 o'clock local time here. And over lunch, she usually asks what's going on and what's happening. And I had one thing in mind before I came up and did my final review for the show. But, she was basically saying, boy, if anyone doesn't think that the markets are driven by emotion, this certainly should convince them. And I think it's right. If you look at the futures from, yesterday afternoon when they opened or yesterday evening to where they're at today, the move higher, the reaction, again, the market gapping up so much. And if you look at things like, Amazon down 5%. You look at Delta Airlines up 17%. Airlines, American Airlines up 16%. These are huge gaps higher. And essentially the market is pricing in, a vaccine is now widely available and everything's going to get back to normal very soon. Or it's certainly questioning the amount of negative impact that we're going to have from an extended economic shutdown. And I think the challenge is going to be, do trends like this have staying power? And I think one of the reasons why this range of S&P 3,200 to 3,600 makes so much sense to me anecdotally is because there are plenty of tailwinds like we just saw. A news on a vaccine is going to push things higher, but there are also plenty of headwinds that we also are dealing with right at the same time. And so I don't know if there's a clear signal we're getting just yet, but it's certainly telling you that there will be emotional reactions to news related to opening up and shutting back down, of course. So we're going to start with Delta Airlines. So again, the question is, what do you do with charts that change so quickly? And it's funny, Wells Wilder, who wrote, essentially wrote the book on a lot of these indicators on RSI and DMI, parabolic studies, a lot of things we sort of take for granted as part of the technical toolkit. Wells Wilder in the 1970s designed all these looking at commodity prices. And he, among others, have talked about, they designed them really for commodity prices, not for equities. And the reason is why he would trade commodities is because you don't have the company risk and the headline risk that you do with equities. Equities are going to gap up and down because of crazy things. There's a lot of, movement overnight that is going to come into question. And so commodities are a pure play on the trend, or are easier to quantify numerically. And I think, so the question is, what do you do on a day like this? And I think you always see where we're at now and look to the left on the chart. So I think it's compelling right now that something like Delta Airlines, which is back above its 200-day for the first time since February, it is right at its June highs. And I don't have the Fibonacci retracements on here, but that would be another thing you would start to look at. Try to draw some lines that'll give you a sense of where we're at relative to where we've been. Are there key levels, key lines in the sand? And hopefully you've had those drawn already. This is not the day to be figuring out what would happen if you're short Delta and what happens if it gaps higher. You want to have that, sort of pre-lab. But I think if you haven't, seeing the fact that we're right at the June highs and that's where we opened and we weren't able to close above that, I think that becomes a really important level. And I think stocks like this being able to hold levels like that are what tell you, about the potential for further upside there. So in terms of things gapping higher, there are plenty of them. Delta Airlines come to mind as one of those. Thinking about any of these within the energy space, you're going to get stocks that are gapping higher. ConocoPhillips is trying to turn an example of the big integrated. So what's interesting about something like ConocoPhillips is if you draw a trend line, we maybe have just broken above it, but boy, it's still, a pattern of lower highs and lower lows. And as impressive as this day is, and again, 14% gain, I would rather be on the right side of that than the wrong side of that. Totally fair. But I think you're still looking back at this 35 level, which we have not even traded above yet, even given the strength that we've seen. So the RSI is still in bearish territory, not in bullish territory since June at the market peak there and the price peak there. This remains in a downtrend based on that sort of that medium-term time frame. So you need to see a higher high, you need to see a higher low. We may build that over time, but I think today is not quite telling me an all clear that energy is the trade to go forward. It's certainly an impressive up move, and I think as that continues to build, as you see the relative strength improve, and have that not be a one-day thing but a multiple-day thing, see that as a trend that's building. I think that would be pretty impressive. pretty much, and again, I'm assuming you've followed the news and you see what's going on in terms of what's up and what's down, but my back of the envelope summary of things is anything that involves reopening and traveling, things like cruise lines, hotels, travel, airlines are all up in a significant way. Uber, Lyft, obviously, as well. Anything that involves working from home, working out at home, any of those things are down big. So Peloton, Zoom, those types, Shopify, all down from a small amount to a big amount. Peloton, maybe the best example of that, back below its 50-day moving average for the first time since April here. So, Peloton's a bit of a concern only because it's gapping, below its price low there from a couple weeks ago, also below its 50-day, also right at 100, almost to the penny, finishing at the big round number thesis. On a day like this, when something like Peloton's down this much, I think it's really important to pay attention to a big round number thesis. So this is the peak from September. This is sort of like that little base before you made that last acceleration into the October high. We've now made a lower high. We've made a lower low. So the short-term trend is low. Poetically, this is about a level that could make a lot of sense to, to bottom out, because it's right at $100 a share. It's a pretty significant level. That lines up pretty well with the September peak and the late September peak. I think that's important as well. If you do roll down here, I think looking at some of these previous support levels, and unfortunately for Peloton below there, it would be down in the in the late the mid-September lows, which is another 20% down from where we're at right now. But just to finish off, and I know we're a little long on time, so sorry I didn't have more time to look at individual stocks, but I think this is the other reason why we're sort of at a key level. This is the 38.2% level. We hit that almost to the penny today, looking at the high from October, the low from March. So with these stocks that have gapped down or gapped up, I would be looking at price trend, or I would be looking at support and resistance levels. I would be looking at big round numbers. I would be looking at Fibonacci retracements. Those would be the three I would be focusing on to identify some of those key levels in the sand. Peloton at Fibonacci support at 100. The RSI right below 40. I mean, this is kind of for a bullish chart, that's sort of a reasonable place to pull back to. So we'll have to see if something like that holds. There's so many other charts we could look at. If there are any particular tickers you'd like me to talk through a review, just shoot me an email, thefinalbar@stockcharts.com. We'll do another mailbag segment tomorrow. Maybe we can hit one of them at that point. We need to wrap the show 3 and 3 charts in 3 minutes. Here we go. And I tell you, picking 3 charts to try to make sense of today was not easy. So this is a hand-picked 3 among many that I think are really telling. So, the chart of the XLU is a fascinating example of, where I think this market looks like today. You have a lot of things that gapped higher, if not everything, but you have a lot of things that finish at the lows of the day. And in terms of, broad constructive positive movements, that's not the way that I would want to break above S&P 3600. You want to finish in a position of strength. You want to finish on much higher volume. You want things to finish more toward the highs of the day. You want to show that there is buying and there's accumulation. This, the way that these patterns are evolving just on today's trading with a gap higher and move lower, you get patterns, or you get candle patterns like gravestone doji, which is the open and close right at the same level in a long upper shadow. This, you could argue, is more of a shooting star pattern with the open and close around the same level, but a long upper shadow. Those are all distribution patterns. They're all short-term negative, telling you weakness rather than strength over the next couple of days. And the high of today's bar, the high of 68, for example, on the XLU is sort of the stop of that short strategy. So if you think the XLU short-term negative because of this pattern, we break above 68 and it would invalidate that. So you have a broad base, you have the breakout, you have the retest. I think all of that is still in play. It's just telling you that the resistance we're at is pretty significant. It's not going to be an easy one and done. We pop over that level. The XLK is maybe one of the most interesting examples of something that has been working over the long term. You see how this relative strength has been rolling over, which we've talked about. But again, today's bar, which had a chance to break to new closing highs, higher high, higher low, acceleration to the upside, not really following through yet. And then finally, small cap value, impressive move up 5% today. It was up over 8% at one point, if I remember right. But the relative strength, again, we're still nowhere near where the fact small cap value looks better than a lot of other things. But on a day like today, it makes me want to look at that IGAS versus SPY chart. Pay attention to how that thing evolves. Folks, thanks so much for watching the show. Please get your questions in on anything we can look at in our show tomorrow. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.